Hi, everyone. Welcome back to FOW Asia. I'm Joy Teo of Global Investor Group. Thank you earlier, Joka and Richard, for sharing your views on the attractiveness of emerging markets and explain B3's main derivatives products for APAC investors. So now our next panel will focus on commodities and discuss whether commodity can be an inflation hedge amid decarbonization. I'm pleased to welcome Keeve Tan, Head of Futures, FX and CFD of OCBC Securities, to moderate the panel. Keeve has experience in both buy side and sell side, which gives him a wholesome view of the industry and its development. To discuss this topic, Keeve is joined by experts from GLT Direct DMCC, Banks Financial, Bursa Malaysia Derivative Berhad, and Dalian Commodity Exchange. While listening to the speakers, we also like to encourage you to ask questions throughout the sessions via the Q&A functions on your screen. The session is being recorded and will be available on demand. Now I'd like to hand over to Keeve to get it started. Keeve, over to you.
I'm here, Keeve.
Yeah. Please unmute yourself.
Keith, we can't hear you.
Ladies and gentlemen, whilst we wait for a moderator to get his sound to work, our panelists will have a little introduction. Josh, why don't we start off with you?
Sure, thanks, Valida. Hi, everyone. I'm Josh Qiao from Dalian Commodity Exchange, and I'm based in Singapore. I'm mainly responsible for the sales marketing of our internationalized products. Those are iron ore and palm oil futures. And also, it's really a great pleasure to be here again in FOW event. And I'm really looking forward to have a fruitful discussion with the panelists and Keeve. Okay, thank you. Back to you, Valida.
Thank you so much. Mot, would you like to?
Yeah, sure, Valida. Sure, hi, good afternoon, everyone. I am Muhammad Salim. I head up the product and market development as well as the international development for Bursa Malaysia Derivative. Basically, we pride ourselves in being the global benchmark for the palm oil contract. And my role here is to look into the product development offerings of BMD, as we call it, as well as to get more visibility and branding for Bursa Malaysia Derivative overall in the global marketplace. Thanks, Valida.
Thank you, Mohammed. John, would you like to continue?
Hi there, my name's John Browning. I'm Managing Director of Banks Financial, which is located in Hong Kong. We are a broker, but primarily we're involved in cross-border arbitrage between the Chinese mainland and the international market. William?
I think we have our moderator back, but William, would you please like to continue?
Can you hear me?
We can hear you perfectly fine.
Okay, great. Yeah, my name is William Purpura, and I wear a few hats. I'm the chairman of the COMEX Governance Committee. I've been a member of the COMEX for a long time, and a long-time trader. And currently I have a company in Dubai, GLT Direct, DMCC. So we deal in different commodities, different physical commodities as either intermediaries or principals. So it's been kind of exciting. It's a little hot here in Dubai, and I've been stuck here a little longer than I thought, but I've been fortunate to have been, I'm familiar with so many people. John and I have known each other for a while, and Joy. So I'm very, very happy to be here at FOW and really honored to be able to participate in this. And I expect to learn more than I give out.
Yep.
Thank you
Great.
so much, John. And we have our moderator back, and we can all hear him.
Can you hear me now? Can you hear me? No?
Yes, great.
Okay. Sorry that I had to leave the panel for a bit. Thank you for standing the gap. Have we gone through the round of introductions? Have we finished? John, we have?
Yep.
Yeah,
Yes.
so without further ado, I just want to apologize to everyone. The mic worked fine just now, and it just stopped working, so I'm just got myself a private room. But let's not waste time and let's move straight to the topic. I think we've got quite a bit to cover today. And the first thing that, I think a lot of the audience that's here today that wants to find out more about commodities, as an inflation hedge, amidst, talks of decarbonization, they want to find out the opportunities. But we're in a pretty unique situation right now. So we're coming out of a pandemic, for some countries, they're still very much deep into it. Cases in Singapore has gone up. We just had a chat with Salim. The cases are still high in Malaysia. So, for the traders and the speculators or the houses out there that are betting on the recovery from the pandemic, with expectations that inflation may happen, in the near term, do we see, a start of a commodities super cycle anytime soon? For this question, can we start with William? What are your views on this? Is there a commodity super cycle that's happening?
Oh, well, thank you. Well, I'm not sure we are in a super cycle, quite a Condratifian, I guess, if that is a word, situation. But when you talk about different factors that can influence inflation, obviously the pandemic is having an effect on things, but we also have money supply increases based on, because of the stimuli that has occurred from governments around the world to increase economic activity and to help people that are out of work. But there are all kinds of different factors that weigh in on what causes inflation. And the problem with trying to assess what inflation is going to be or what's going to happen, everyone comes into it subjectively because we all put different weights on each of these factors. And we all have biases that are built into us. So what I try to do is look at objective measurable factors. And to me, and all through my career in trading, it's been the price, because that price is the distillation of all of these factors, and it's giving you a number, and it's a measurable number, and it's objective. So quite often people will make predictions, again, based on what they expect the market to do, but the market really doesn't care what you think, and it's not going to listen to you. So I try to listen to the market a little more. And so what is the price telling me? What's the price structure? Can I identify, say, inflection points in the markets? Well, what are the support resistance levels? Can you, and you can analyze these over different time periods depending on the way you approach the market. So you can trade from 5-minute time periods to 5 years. So this kind of approach helps to cut through the noise in the markets. And given the situation that we live in now with communication and different types of sources of information, sometimes we get into a situation with the economists Herbert Simon said a long time ago, a wealth of information can create a poverty of attention. So that's why I try to take the noise out of, when I make an analysis of the markets, and I try to look at the price structure. Okay, and how is the price reacting at certain levels? How does the price react to certain news that comes out? And then try to make a determination of where the next thrust in the market might be.
Yep.
So that's kind of what I look at.
Yeah, I think that's a good point. So William, when you look at the price, and because at everyone's minds, and when I speak with commodity traders, everyone is looking at a super trend, a super cycle. They are trying to look at what the industry, what the market is telling them first. And to see that, okay, they're going to be general price increase. They look for the dips to get into the markets. But you seem to look at it really differently, right? You allow the price to tell you. It's almost a bit like tape reading. And so has it been working well for you?
Yeah, well, and the way you look at it too, if you want to look at, I did a lot of study on cycles a long time ago when I was trading. It was very, very interesting, and over different time periods. And so we can stretch out that analysis when you're looking at prices over a longer period of time to see where we're going. And what I'm seeing right now is that we are in, most of the markets are in a intermediate, slightly bearish area, because it's more of a correction from some of the stimulus and some of the things that we had as economies started to pick up. And I think that certain levels, if they're breached, we could go into more of a regular business cycle upswing in inflation in some of these commodities. I'm not quite sure that I would term it a super cycle at this point.
Okay, John, anything from you? I know that you are managing the business, good business, advanced financials, and I'm sure that you deal with a lot of commodity clients. So what are you seeing from the ground? What are you seeing from your clients and the market in general about this commodity super cycle or the recent change in prices?
I'd disagree with you. There you go.
I love it. I'm getting excited.
I think a super cycle is when commodities trade over their long-term trend for a longer period. And the question is whether we're going to see that in the near future, let's say over the next 3 years. I think the paradox of what we're seeing at the moment, and I'll probably use that word a lot over the next hour or so, is that the low carbon economy needs raw materials. And as an example of that, I mean, China produces 35 million tons of aluminium. It's a lot, the biggest producer by far. But in 2018, 90% of that was being produced, 90% of the electricity to power that was produced by coal. Now, coal emissions are going to be suppressed, and they already are. And you may see the total volume of aluminium production being capped. Now, if that happens, there is no room then for the low carbon economy to attach itself to more aluminium production. And we're seeing that idea already in the price. It's already at a 10-year high. So my feeling is that the low carbon economy is going to, through the taxation of production, is going to make some steep changes into the way that we see many commodities, and that may not affect all commodities in the same way. But to William's broader point, I think the pandemic has produced a change, in work. It's produced a change in what it means to be employed. It's certainly produced a change in transport, which may never go back to what it was, a few years ago. And so I think we're seeing quite a lot of contradictory numbers around, produced by the governments or private services. But I'm tending to feel that the data is no longer as reliable or insightful as it used to be because of these external effects, from the pandemic hitting, hitting the data that we normally see. And so I would tend to, my gut feeling is that this is going to, mature into some, how can I put it, self-fulfilling inflationary cycle. As people expect inflation, they're going to get it because they change their decisions, they change their choices to anticipate the inflation that they perceive coming down the pike. I mean, in the US, the figures there are that the general population expects inflation of 6.5%. So, I would feel sure that they're already changing their decisions to be defensive of that, house buying as well. And that is causing, that will cause an inflationary boom further down the road. So going back to my original definition of is a super cycle nearby, certainly one I would argue that that it's possible that the fabric for a commodity super cycle is going to emerge, and that is long-term prices. Prices will be over the long-term average of where they've been for a few years. Yeah, I think I got with that.
Yeah, thanks for that, John. I think, at the very crux of this argument from John, it's really us transiting right into a low carbon economy. And that's very often, no one chooses just going, let's just go low carbon. People go low carbon, or economies go low carbon because of regulations, because governments sit together and say, hey, let's do something about the situation. And that is why, according to John, it would likely affect the prices in the long term. William, does that make sense to you, or is that going to affect your trading, or do you probably not relevant to trading?
Well, yeah, anything that affects the market is going to affect the trading, and it's going to affect the price structure. And my point is that I try to see what is the price, how the price is reacting to this. Now, the other thing that's kind of a wild card in this thing is this whole low carbon issue. The issue is, first of all, again, a lot of the noise that we're hearing are the political and policy solutions that people are coming in. Are they going to make any sense, and are they going to make any economic sense? Because, we hear everything from on a panic basis on the climate and what the necessity of doing this is that we're going to be, everybody's going to be dead in 12 years, or it's not going to be a problem. And it is obviously somewhere in between. But what's the response that policies are going to have in economics? Now, suppose everybody took the same approach that France does, and we went to nuclear energy. Okay. And does that solve the carbon problem? Well, largely when it goes to coal, but is there an appetite for that globally? Probably not. And who are the interests? Who are the money interests in whether it's solar or anything like that? And John's got a great point. Commodities, say for solar and things like that, are going to be very important. So you're going to see increase in mining, rare earth metals, and that's all a very dirty business. So how is that affecting it overall, and how is it affecting, and are we going to have a stigma against fossil fuels, which are still going to be necessary? You take something like natural gas. Where I live in Pennsylvania in the US, we sit on the Marcella shale field, and through technology and fracking, we can get more natural gas than the United States can use, and that burns clean. So, but what are the political solutions to that? And we go on. So how far is the world going to push this? And that's going to, I think, those type of solutions are going to create, where is the demand for different things, different commodities can be. You see, lithium with batteries, and electric cars still need to be plugged in. So that's one thing. And then, but going to a low carbon thing, now there are markets. So to get there, and we'll talk about that a little later, things like carbon credits, and they're to manage that, to manage your risk of regulatory or even voluntary, solutions to carbon emissions, and what certain industries' roles are in that. It's going to be interesting in how that goes, because a lot of the models that are used, whether they're economic or scientific, are flawed, and a lot of them are. And just like if you put a trading model together and you have a bias, you're not going to be putting the right information in. So a lot of it is subject to what's going on politically, and what and also how do other countries react. We talked about, China has a lot of, they're still burning coal like crazy, and if you take a look at, say, the Paris Accord, I don't know that very many people have actually read that thing, but it's to me, it can't go with something like that. That's not something that's going to be effective, other than to make everybody think, or politicians try to make it look like they're actually doing something. But there got to be other solutions, and there are good solutions, and the economic impact on people and their quality of life has to be weighed, I think, against some of these policies. But maybe that got a little too political off the marketing, but I think overall that's going to affect what we do.
Yeah, thanks for that, William. I don't think that's anything too political. I think it's always interlinked. There are different stakeholders in this whole ecosystem. You talk about the coal usage in China, but there's of course a lot of people who criticize the Paris Agreement, say, hey, it is the developed countries that are sitting together, after decades of polluting and increasing the growth of the economy until you reach a mature state, and now you create all sorts of ESG indicators to stop the developing countries or the growing countries, from achieving their growth, in an efficient manner, or a manner that has been useful for many years. Now you start to tell them to leapfrog, using of coal, to go straight into electric vehicles, and some deem it as unfair. This is not our topic for today. Maybe FOW can consider it someday. But since you mentioned China, Josh, I wanted to find out, what are your views, on these commodity prices, and what John and William say? Do you agree, disagree, and what are your views? Are we in a super cycle? When it comes to commodities trading, you are an executive manager in the exchange. What are some of the trends that you can see?
All right, thanks, Keeve. First, just respond to William's point. Whether or not that we are having the right solution, or whether it is going to be effective, we are heading the low carbon anyways. So globally, nations are more concerned about the environment. Yeah, and also that includes China, of course. So the carbon peaking and carbon neutral targets, which was first brought up last year, is now one of the most discussed topics among regulators and also different economic sectors in China. And China is really working hard to achieve the carbon goals. And also 2 months ago, the spot carbon trading has started in July, and it marks the establishment of the physical market. So I think as we move forward, we'll see significant development of China's carbon market. And also for about commodity super cycle, I don't think it is going on, because if we look at the previous super cycles, there were changes in the economy that were really structural and transformational. Also, it could last for decades. But I don't think this time it is the case, and there were just not enough drivers for a super cycle. However, from an exchange point of view, we do see the overall commodity market is growing. So some stats from FIA, the first half of this year, the trading volume on agriculture and also metals products is about 70% more than the same period in 2019, the pre-pandemic time. So yeah, my point of view is that we may not see a super cycle coming, but yeah, but it's always to have always good to see our industry growing, whether or not it's inflation is central banks pumping money in, but everyone's happy. Yep.
Thanks for the point. I'm not sure if it's you know, we are allowed to quote numbers other than FOW numbers, but I guess FI numbers will work fine for now. You know, Josh, I wanted to pick your brain. You know, thanks for sharing with me. I wanted to pick your brain on iron ore trading. You know, obviously for DC, you know, one of the major products, iron ore trading. You guys run one of the, I would say, largest franchise of iron ore trading, you know, outside of China, in China. You know, with now iron ore trading, you know, going across different venues, different locations, what is the landscape that you're seeing now, and what is some of the advice you have for our listeners? You know, where is the demand coming from? You know, whether it's paper or physical.
Okay, I'm glad you brought it up. So iron ore, I think it was one of the hottest commodities last year, and recently it is in the spotlight again due to its high volatility. And for DCE this year, iron ore's volume dropped because the exchange imposed some risk management measures. And however, the overseas daily open interest is still quite steady, stays at around 5%. And that converts to 3 to 5 million tons per day, which is still quite a lot. And I think Dalian and Singapore are the most important iron ore pricing centers. The two markets are complementary to each other. SGX has a wider range of products that are priced in US dollar, and DC's iron ore is more active. That makes it a really good benchmark. Also, because China is the dominant buyer of iron ore, and iron ore is now an important material for the infrastructure and also the ESG infrastructure. So the product has the ESG concept and also the economical and financial features that are embedded in it. For example, it's related to Forex, RMB exchange rate, housing market, automaking industry. And to answer where is the demand come from, I'd say it's from everywhere. So high price attracts producers and traders to lock in their margins, and volatility and liquidity is good for algorithm trading and also HFTs. Also, as I mentioned, those economic factors that are in the iron ore futures is attractive to the funds. We see more funds that use iron ore futures as their to allocate their assets. And I think the demand for iron ore trading, futures trading, will remain at really high level, and will expand it across the globe. Yeah. Back to you.
Thanks for that, Josh. Yeah, I think it's an interesting coverage of what you spoke about trading. You know, but what was really interesting is the demographics of traders, right? I mean, when it comes to iron ore trading, you mentioned it's not just the producers, but you mentioned the HFTs, the high frequency traders, the people who are hedging the prices when it's high. You know, William, I want to ask you, you know, yourself, you know, having traded many years, always looking for arbitrage opportunities, always, your firm is an expert in trading commodities. Can you share with us, you know, what do you think about iron ore trading? Do you think it's changed over the past few years? Are the participants any different? Are there any opportunities? You know, in iron ore trading, you know, Josh is obviously very bullish about the future of this product. William, you have to unmute yourself, William. Can you unmute yourself?
Yeah,
yes.
There we go.
All right.
Yeah, I'm approaching the market from a business perspective differently than I have throughout my whole career, because we're involved in the physical part of the trading. So we've got an arrangement with a series of mines in Mexico, and we're just contracting to do some sales into China and into the United States. And pricing on that is always a challenge, because if someone wants a long-term contract, they want to either set a price or do it off of some kind of a discount. So the price analysis that I've been doing is less for trading than it used to be, but it's more for understanding how to price the physical market. So what I saw was back in March, there we had a parabolic move up into the middle of May. And going back to some of the measurement things that I try to look at, it's amazing. It's been amazing to me over all the years about how some of these things reoccur, no matter what kind of trading venue you're on. But some of these Fibonacci retracements are pretty amazing. So when we saw the market do that parabolic move up, you can always expect some kind of correction. And that thing corrected right around the 62% level and held, and then went back to the high. So we're talking about going up to just under 210. 210 a ton, and then it came back up, tested those highs, and failed again. So you established the resistance level. It couldn't go through that. The next retracement, then it came almost all the way back down, and now we're bouncing back up, and we bounced up to one of those numbers. So right now, what I'm looking at is we had a low of around 133 recently, right around in that area, and a correction up to around 161, and now we came back down about halfway in between that. So one of the things I would look at this point is if the market, and this is going to help me when we try to negotiate physical prices to understand, if the market goes back down under 133, we could have a significant move down, but I don't expect that to happen. I expect that to hold, and then I expect if the market goes up above the 161 area and spends a few days like around 163 or so, I think that could be the impetus for the next leg up, and maybe take out those highs of 210. And what I think that'll do is, the market is telling you is that demand is starting to come back in. Now China has had, and Josh, I mean, this was my thing in the market, is that people came to us from China because we have North American iron ore, and their thing was, hey, well, we're not supposed to buy from Australia. So there are political things that have happened too. So I'd like to ask Josh, what do you see the relationship between China and Australia as it affects the physical market, or what's coming in, and have you noticed that have a big impact?
Okay, all right. First, let me clarify one thing. By saying the demand for iron ore trading, I'm not saying the physical demand for the product. So I did not comment on the supply and demand on the physical side. And William, on that, if we just look at the numbers, China is still Australia's biggest buyer on iron ore, and I think that's what I'm going to say later. Probably nowadays the geopolitical issues is less trouble than 1 or 2 years ago. So yeah, I don't think that's going to be a much problem for the market.
Okay, great. I'll keep that in mind.
Okay, thanks, guys. We do have to move on. Since we talked about the supply and demand, and obviously that affects the price, right? It affects the price of commodities. But I wanted to pick the brains of Salim and John. So perhaps Salim first. Besides just supply and demand, can you share with us, what are the drivers that moves the markets? What these price movements? What are the different drivers? Whether it's agricultural commodities, energy, metals, and Salim being at exchange. Can you share with the audience today? What are the price movers? Salim, you have to mute yourself. You have to unmute yourself. It happens to the best of us.
There we go. Yeah, technicals again. All right, thanks, Keith. I guess in the agriculture commodity space, our flagship crude palm oil futures, the FCPO contract, is the global price benchmark for the palm oil in market players. So from the agriculture commodity space, taking it from the context of palm oil, I would say the COVID-19 pandemic has been one of the key drivers. I mean, it has definitely adversely impacted the output of palm oil in the region, with governments imposing travel restrictions. Harvesting activities of palm fruits have been actually greatly affected as palm oil estates face severe labor shortages. This is especially the case in Malaysia, as the country is really highly dependent on foreign workers. More than 70% of the estate workforce in Malaysia are foreign workers. So the shortage of harvesters is estimated to be in the region of 40 to 80,000. And recently, the Malaysia Palm Oil Association, or MPOA, had earlier at the peak of the movement lockdown, estimated that 20 to 30% of production could have been lost due to just this reason. A more recent data from the Malaysia Palm Oil Board, or MPOB, shows that the fresh fruit bunch production reduced by 3.8% during the period of April 2020 right up to June 2021, which was caused mainly by the labor shortage. Hence, CPO production for the year is projected at 18 million tons, which is a drastic drop from the 19.15 million tons last year. I mean, as a result, we have seen over the past year significant rise in the price of crude palm oil itself, from prices around the ringgit Malaysia 3,200 per metric ton at the start of 2021. Our third-month benchmark crude palm oil futures contract has witnessed a historical high of ringgit Malaysia 4,560 per metric ton in mid-August 2021 recently. So yes, having said that, this I would say would have been one of the key drivers behind price movements.
Oh, I think that's fantastic, right? That's a really good breakdown of what drives supply, what drives demand, and the lack of, whether it's demand or supply. John, anything to add on there? What moves the markets? What moves the price?
I would look at it a different way. I'm quite happy with what everybody else has said, but I do have a different view. That is that commodity prices are primarily driven by location, quality, and prompt date. Certainly if you're a merchant, right? So if you're a merchant, you should be looking at those three, in particular. So location, quality, and prompt date. And from time to time, those elements get out of sync. So you do see, when oil went to negative prices, because there was no storage facilities in the US, what's it called, Henry Hub. Therefore, oil became valueless. It went to, it went down below zero. In fact, an occurrence that was foreseen by the exchange, because they made sure that the exchange could trade negative prices a few weeks before it actually happened. I think more interesting, or something similar but different, was the price of gold, which happened a few months after that, when because of COVID-19, 2 refiners in Europe closed down, and there wasn't enough 400-ounce bars to supply to COMEX, and consequently the price of gold on COMEX started to lift dramatically above the price in London. And so it's difficult to know, which is exactly right, which is the right price of gold. However, probably less well known at the time is the price of gold in China went down below the price of gold in London, opening up a significant arbitrage between Shanghai and New York. The reason being is that you couldn't export gold out of China, and because the border was closed because of the pandemic. So I would argue that within Williams' figures is this nuance of location, quality, and prompt date, which is there and creates a and from time to time can get out of sync. So that would be where the merchant type traders would be. Of course, on top of that, there's a whole bank-wide industry of people looking at the long-term demand and supply driven by currency movements, geopolitical situations, economic growth, if you've got any, transport costs, profitability. And I think we have to add to that the cost of the environmental cost of production, which is, I think, a new feature that's going to come in to those, to the big, broad brush elements that the sort of bank-driven investors, the hedge fund-driven investors will look at. So in terms of price drivers, I think there's two streams. You have to look at the nuances within the commodity itself, and then the nuances of the environment in which that commodity exists. And going back to my earlier point, because I'm not going to let it go, is that the future cost or the additional cost of the environmental cost of producing commodities, paradoxically, is going to go higher on the very things that are needed to produce a low-cost environment, low-carbon environment.
Yeah, thanks for sharing that. I thought that was really informative. I particularly liked what you mentioned, and in particular the quality, location. And it's been I think a chase, for many traders. William, I'm sure, the same quality, same commodity, can we arbitrage in the two different locations, right? The price is different. And this is something that I believe a lot of our audience will be interested in. So I would like, Salim and later William to share a bit more, let's say for the good guys, okay? I'm going to call the good guys the people who need to hedge, who genuinely need a commodity futures to hedge out. Can you share, what are some effective tools to hedge, on the commodities that they need? What are the markets they can access? Should they be using futures, options, or could they be using ETFs, to hedge against the entire supercycle if they like? And then secondly, we go to the bad guys, the clever ones, right? That use commodity products for arbitrage purposes, make use of same quality, different location, different price, and make a profit out of it. Salim, would you like to start?
Okay, sure, Keith. So with the good guys and the bad guys as the exchange, I think we need to have a bit of both in order to have a fair and tradable marketplace. Having said that, with prices of commodity being particularly volatile in recent years, from the way we look at it, futures contracts like our FCPO would provide market participants with the effective avenue for hedging and managing their risk against price volatility, as well as arbitrage opportunities. Just as an example, taking Malaysia again as the context, back in 1995, when West Malaysia produced like 78% of the overall CPO production in Malaysia. However, now coming to fast forward 2020, East Malaysia is actually producing 45% of the CPO, overall CPO production. So identifying this increase in the East Malaysia side of CPO production, we as the exchange, we are actually looking at launching a new contract, which is the East Malaysia crude palm oil contract, which we are calling it FEPO. And that's to be launched just around the corner in October 2021. This will basically provide a new avenue for price discovery for CPO produced in East Malaysia. As this contract is actually catered towards the East Malaysian palm oil players, it serves as a good hedging tool to manage risks associated with price fluctuation, as well as it can be used by the bad guys to capitalize on any arbitrage opportunities between prices of West Malaysia and East Malaysia CPO. I mean, in the wider scheme of things, both the FCPO and FEPO will, provide that arbitrage opportunity with other edible oils such as DCE's RBD palm oil or soybean, as well as CBOT soybean oil futures as well. So for investors who have access to global markets, availability of this different edible oil contracts would present valuable arbitrage opportunities for them to actually capitalize on as well.
Yeah, okay, thanks for that. I don't want to take this too far. I said that, guys, just to spice things up, I hope the arbitrage traders here are not upset with me. There is actually, I've had this discussion many times, right? There is real social or public utility of arbitrages, because they help in price discovery. So you are the good guys out here as well, just not as good as the hedges. Yeah. So John and William, anything to add to what Salim has said?
Well, I think going to John's point, John addressed that when he mentioned what happened in gold, is arbitrage has come as it can be very risky as well. So what John was referring to was the COMEX price and the EFP price, which should be the difference between the spot London price and the futures. When the futures went into delivery, typically London would take their 400-ounce bars, they would take them to the Swiss refineries, they make them into kilobars, and they'd ship them to New York. Now, when you had a lockdown in Switzerland and a lockdown on flights, they couldn't get those kilobars against their short obligations in New York, drove the price up. That was primarily from the banks. They couldn't get out. So now typically when you're trading that, if you saw that EFP go the way it was, after a few dollar movement, you're going to put an arbitrage position on, but it keeps going against you. So that was it was an arbitrage opportunity, but it was very dangerous the way it worked out. And also there are different ways of doing it. You know, Josh, before you were at the exchange, we used to trade your bean products on the exchange, and that was an interesting arbitrage, the crush, because what we realized that we had to trade the CBOT soybeans against the Chinese products, because your crushers would use imported beans as opposed to the domestic beans to create their crushing margins. So we were able to figure out, and we put some models in together, and it was moderately successful, and we did okay. I think if we would have developed it more. And then also, Salim, we used to be market makers in your options on your palm oil options. Mm-hmm. And so so option markets are actually an arbitrage type market, but it's within the same commodities. So an option, your option hedging, your delta hedging, and when you hedge your Greeks, it's really an arbitrage between the volatility and the price of options and things like that based on the underlying. So most successful arbitrage have good algorithmic programs to them to be successful. And you go back to the gold market in China, we were the largest trader of the Shanghai Gold Exchange T+D contract. And because they gave us an arbitrage exemption, and we would make markets on the Shanghai market all day and leverage it off COMEX. The problem happened, and you get into a regulatory issue on that. They came in and they started limiting how many cancellations we could put in the market. So if you're making a market someplace and you're constantly moving your market around and you have a cancellation limitation, we had to stop because we couldn't do it anymore. But and other arbitrage opportunities, when let's say you have let's say you're sending WTI and you're shipping it out someplace, but the contract you have in the physical market is based off of, say, a Brent price. So to hedge, to arbitrage that, an arbitrage hedge, you can go into the futures and do a WTI Brent hedge arbitrage, or just do it as a pure arbitrage based on prices. But again, it can be dangerous because if a dynamic in the market changes fundamentally, and one leg of your arbitrage starts to spread out farther, you're almost necessarily going to be on the wrong side if you're expecting a mean reversion. So those are the type of challenges, but they also create opportunity, and it can be in any market. So but you do have, in that case, you do have to have a fundamental understanding of the market and why it should act the way it is. And the other thing too is, particularly in China, if you're arbing a Chinese market against an international market, you've got currency risk there too, because if there's a devaluation or an effect of the RMB based on, say, the US dollar, that the other stuff is doing, that'll create something. Correct. Too. So you also have a currency arbitrage.
Yeah, thanks for that, William. I think it's a good point. I just wanted to jump in here because you just talked about something I really wanted to ask Josh about, and that's China, right? The arbitrage market for China versus the rest of the world. I think it's huge. I think, William, you're an expert in that. But Josh, from what you're seeing, can you share, with the audience, what are some of the opportunities out there?
Yes, just like William said, even before Chinese market opening up, people are already doing cross-border arbitrage. Now with we have more products open up. I talk to traders, and some of them are doing arbitrage, some of them are doing BMD and DCE, the margin between the DCE and BMD. So yeah, I think it's as the Chinese market open up more, there will be more opportunities for the traders. And a problem that occurred during the cross-border arbitrage is that when the product is not open up to the international market, people need to have sufficient funds for the margin requirements in either side. But when we have more products, there won't be a problem, because those overseas brokers, they can handle the margin differentials. And just want to share that one thing, the China is determined to open up further on its financial markets. So just a few days ago, the State Council rolled out 19 measures to promote the trade and investment, mainly on the free trade zones. So among the 19 measures, there are 2 of them. One is adding more futures products to the current pipeline, and the other is to accelerate the commodity internationalization. So I believe in the near future, there will be more cross-market opportunities, both cross-border and inter-China. Yep.
Right, thanks for that. In view of a shortage of time, I'm going to go on to the last thing I want to cover today, and that is sustainability, carbon neutrality. That came up a couple of times during the talk. Salim and William, can you share, what do you see in this trend, or this sustainability trend for commodities trading, especially when carbon neutrality is an aim for a lot of companies? William, you want to go first? Let's keep it to about 30 to 40 seconds each, so that we can hopefully cover.
Sure, and there are a lot of aspects to that too, because you wind up, and John brought it up too. A lot of one of the big things is logistics. So shipping companies are under a lot of pressure to reduce their carbon footprint. So there could be carbon credits that they get involved in. So that's one market. You also touched on the mining aspects of it. It takes a lot of energy to mine, and there's a carbon footprint for that to get these new raw products out of the ground. So different carbon credit schemes, whether it's on an exchange. I know CME has one, and DCE, Josh said that they have one, and there are other solutions that are coming out there. A couple of them in Singapore that I'm familiar with that'll take advantage of blockchain and things like that to try to use carbon credits as a market-based solution for your carbon risk.
Salim?
Yeah, I mean, just again on the sustainability side of things, with respect to palm oil again, I mean, Malaysia on its own has also launched the Malaysian Sustainable Palm Oil, which is the MSPO, back in 2013 and implemented it in 2015. Aim was to basically encourage sustainable practices by the palm player, mainly the producers in Malaysia. As of July 2021, 90%, up to 90% of the Malaysia's total planted area for palm oil has been certified sustainable under the MSPO certification scheme overall. And as the exchange, we also play our part by, our commitment to leverage on our reach to foster sustainable development and promote responsible growth for the industry. And as of 1st April 2021, the exchange has made it a requirement for all physical delivery via the exchange to be MSPO certified. So I guess, with what's happening in the world, that is the way we are heading. But I do take note of, what John had said earlier, that, the future costs with all these environmental, things that's going on is definitely going to lead to higher prices, definitely in the end.
Awesome. Thanks for sharing your views. I'm afraid that's all the time we have today. Thank you for joining the panel tonight. And thank you to all my distinguished speakers for sharing their views. Back to you, Joy.
Hi, thank you, Keeve, for moderating the panel. That is a really interesting, very wonderful, insightful panel. And I also like to thank William, John, and Salim, and Josh for sharing your views on various aspects of commodity markets. I think we can go on for days. Thank also to the delegates for sending your questions. So sorry for, due to time limit, we can't answer during the panel, but I'm sure that there will be occasions you can interact with the panelists. We hope you have enjoyed this session and found it very informative. So that brings us to the end of today's sessions. And I'd like to thank all our speakers and delegates for participating. And I also like to thank all our sponsors, supporting organizations and supporting associations for their support in making this event possible. So we hope that you all enjoyed today's event. If you have missed any of the sessions, they will be available on demand. And tomorrow on the 9th of September, we will continue with FOW Asia Day 2 sessions, and we'll start at 2 p.m. Singapore time, Hong Kong time. So the Day 2 agenda will consist of 3 panel discussions and 3 fireside chats to discuss ETF trading, ESG integration, globalization of risk management, equity and equity derivative for APAC investors, fintech innovation in the derivative market, as well as digital assets, blockchain, and marketplace, what's next in play. So thank you again for joining today. So we look forward to seeing you tomorrow. Goodbye for now.